All right, friends, welcome to you all around the world. Welcome to this Follow the Money podcast, episode number 462, entitled U.S. Stocks Hit Record Highs. What's the occasion here? Why are stocks climbing to new record highs? Well, it all has to do with the latest inflation report put out by the Bureau of Labor Statistics. U.S. inflation in the month of April, the CPI report showing signs of cooling, bringing a potential sigh of relief for investors, and hinting, I think, at a more cautious approach from the Federal Reserve in the near term. And we got the latest report out this morning. Of course, I'm recording this on the 15th of May. This is Wednesday morning. And the latest U.S. Consumer Price Index report showed that consumer prices rose 3.4% year over year. That was in line with forecasts in the month of April. Month over month, however, the U.S. inflation rate rose by 0.3%, which was an improvement for the last 2 months, and it was below the forecast that analysts had expected of 0.4%. Now, it all kind of sounds like we're dealing with minuscule numbers here, but we're actually dealing with numbers that have been hurting us at the grocery stores and at the gas station and all the different places that we go. Inflation has really been a difficult beast. Not just for the U.S. consumer and, of course, U.S. producers, but for the Federal Reserve, which is trying to rein in these inflationary pressures. Of course, many people can point to the Federal Reserve and say, well, they're largely responsible for what has happened. And in some ways, you could build that case. In fact, we've built that case before in the past that, the Fed had the opportunity to begin raising interest rates sooner than they did. In fact, all throughout 2021, it was becoming evident that the inflationary pressures were rising, and yet the Fed kind of sat on its hands and it waited a little too long until finally in 2022, we saw the inflation rate, the year-over-year rate, rise to a peak of around 9% or so. It's since fallen back down, as we said, the annual or the year-over-year rate now on the CPI is 3.4%. Well, anyway, that was cheered by markets. As we speak this morning, we've seen the markets rally to brand new record highs. The S&P 500 trading above 5,300 for the first time, 5,312 for the first time. We have the Nasdaq 100 at 18,590. We even have the Russell 2000 rallying, small cap stocks and the Dow Jones, everything moving higher. And then we look at some of the various commodities like gold, for example, up 1% here on this news, and silver up more than 3% at just below $30. We'd like to see silver break out above $30. That would be a pretty big deal. And when you look at the U.S. dollar and you look at the volatility index, both of them are in retreat here based upon this latest data from the CPI, the latest inflation data. Now, this inflation data, of course, as we've said, is not perfect. In many ways, it's not perfect at all. But it's what economists consistently use to measure the overall inflation rate here in the United States. And so all things being equal, we look at it and we have to measure it in that light. Now, when we look at what the expectations are for the first rate cut from the Federal Reserve, we're looking out to about still September. The odds have improved for a July rate cut some since this report was put out today. But nonetheless, it's still really the majority the majority probability is for a rate cut in September. And in fact, that probability is around 70% now. So it's pretty elevated. And we would expect that number will continue to rise. The Fed has basically made it known that they're done raising rates and they are looking for a weaker labor market to really signal or kick off the span of rate cuts that they're going to inevitably, implement. And you got to keep in mind, when the Fed begins to cut interest rates, that's really pretty positive, for the overall market, especially when interest rates have been held at the current levels they are now, above 5% for some time. The economy doesn't seem to be cratering under the 5% interest rates, despite the debt loads, whether you're looking at government debt, state or local or federal, or whether you're looking at consumer debt or even business debt. The current interest rates are not causing dramatic dislocations in the economy right now. Now, time will tell. If the Fed leaves rates where they are for too long, we could really begin to see some weaknesses appearing in such things as a stark rise in bankruptcies or a stark rise in delinquencies. We've seen some of that, but not to the level which you would expect, with going from 0% interest rates up to north of 5% interest rates. And speaking of yields, we've also seen bond yields come back as well. Over the last several weeks and even for the last few months, we've seen the U.S. dollar fairly elevated, though it's certainly off of its highs that was reached back in 2022. It's still kind of stubbornly high, right along with that inflation number that remains above the 2% goal of the Federal Reserve. But today, we are seeing bond prices pick up as those yields do retreat. And that's really what we need to see. We need to see the market really projecting to us, not just in terms of equity prices, which we've already seen the stock market now at a new all-time high. But what we're looking for also is for those bond prices to start rising in anticipation of the rate cuts, to signal somehow that they actually believe that those rate cuts are here. And we've already had the Fed pretty much say everything but that they're going to cut rates. They've already said that's the plan. They've already said that they are no longer going to hike rates anymore. They've already made the point that they're waiting for a weaker labor market to justify any rate cuts. And we've already begun to see weaker labor data. So in essence, we have all the all the pieces in place for a rate cut, and the market just is we're looking for bonds to begin to pick up and yields to back off a little bit and relax, so that we can see that that's what the market is expecting. But if you look at stocks alone, you're going to see that they are doing very well in this environment. They've been rallying, although we had a swoon in April. April was a peak where we hit a peak, and then we began to pull back at the beginning of April. And we kind of came down probably for the first 3 weeks or so. And then we began to rebound, and then we began to move higher since that time. And now we're at that new all-time high on the S&P 500 and the Nasdaq. So good to see the markets are responding to this and moving higher. I hope you're invested. If you're a long-term investor, I hope this is benefiting you, your 401k, your IRA, wherever you're investing. You have to invest if you're hoping to, keep up with inflation. If you just want to be able to beat inflation, you have to invest. And you don't have to invest, of course, in the stock market. You can invest in many other asset classes. But stocks certainly are, historically have done well in times of elevated inflation. They've served to protect, purchasing power, right along with other types of assets like gold and silver, and also even things like Bitcoin. When we look at Bitcoin this morning, we see that it has really had a big run. In fact, it might be the biggest beneficiary of this CPI report, rising up to around 65,000. Now, we have been watching Bitcoin now for some time. Of course, we've been watching it for the last decade or more as long-term investors in the space. And, we have been watching the key level of around $59,000 on Bitcoin. It's been holding, right above that 60,000 level now for the majority of the month of May. And today we're getting a very nice rally up to 65,000 or so. We are, as many of you know, very bullish on Bitcoin this year and especially next year. At the beginning of this year in our 2024 economic outlook and market outlook in particular, we stressed that we expected Bitcoin and Ethereum, as well as gold and silver, to outperform the overall market. And when we talk about the overall market, we're really talking about the S&P 500. That's probably the best benchmark that we would be able to track. And the S&P 500 up, around 10% or so this year to date. That's really good. But gold and silver outperforming the S&P, as well as Bitcoin. Bitcoin, having a really good year this year. If you look year to date on Bitcoin, for example, we're up more than 50%. If you look at Ethereum, it's up more than 30%, despite the relative pullback we've seen, in recent weeks. I know many of you listening do invest in cryptocurrencies like Bitcoin, like Ethereum, and I know many of you are like us. You have an expectation of 2024 and 2025 to be, better than other years, at least in recent years, because of that 4-year cycle. We are in the post-halvening era now. Typically, the halvening month, almost always the month that the Bitcoin halvening occurs, is down. Is usually a down month, and that's exactly what we saw in the month of April for Bitcoin. It was a down month. But then when you look at post-halving months, you begin to see that they really begin to accelerate. Sometimes it takes 2 or 3 months after the halving for Bitcoin to really begin to take off, to move to its new high. Other times it just takes off immediately. So we'll be watching how things perform in the month of May. This is the very first month after the halvening. And typically the halvening month is down, which we've seen the last, several halvenings. But then as we move it post, halvening, then you tend to see that market rally. So we're looking for a rally in Bitcoin, to continue in the month of March, and then moving on through June and July. We think by the end of the year, certainly in the fall, that Bitcoin prices could be at a new record high. And then in 2025, we think that's going to be a really big year for Bitcoin. But we also think that's probably the year, in fact, based upon our data, probably by the fall of 2025, you will have seen the peak for that cycle before Bitcoin then begins to turn back around and, kind of find a do price discovery and find a new low that may come in 2026 or so, 2027. Yeah, I'm looking here at some year-to-date data on performance on many of the major markets. I'm looking here at silver up more than 23% year-to-date. So that's a really good return for silver. We see gold up more than 15% year-to-date. And again, all of that is bigger than the S&P's 10 or 11% gain that it's had year-to-date. Now, some of the laggards this year have been the dollar. Even though it's up 5%, it's beginning to descend, and we expect that's going to continue. You see, as interest rates rise, that is the price of money. You learn that in Economics 101. What's the price of money? Well, it's the interest rate. And so as you raise the price of money, money becomes obviously more valuable. And as you lower the price of money, well, then that makes it less valuable. And so overall, as you look at it on the, in terms of a chart, one of the things we watch on the U.S. index is we're watching for a breakdown on the U.S. dollar below the 100 level. And right now it's trading, around 104 or so. So it's just slightly above the area we're expecting a breakdown to occur. And as the Fed begins to cut rates, as it begins to telegraph that, okay, we are going to cut rates this month and we're going to continue to monitor the space, well, this is going to lead to a downward pressure in the U.S. dollar. And if you know how the dollar dynamic works, as it falls, as that index falls in value, well, obviously it's falling in value relative to what? Well, to a basket of other currencies. So you'll see things like the euro and the Swiss franc, and the British pound, they will begin to rise as the dollar falls, because these, you got to really think about currencies almost like seesaws. If one side goes down, well, the other side is going up, right? That's how these currencies work. So you have to keep that in mind. So those of you living in Europe, those of you living in other parts of the world, need to be prepared for a rise in your currencies as the dollar begins to fall. Many of these countries have seen their currencies fall in value, especially the Japanese yen, but even the euro and many others. Since the dollar has really been ascendant, but now that the dollar is coming down, and as we see it accelerate to the downside in the wake of those imminent rate cuts sometime in the next few months, then that's going to lead to a downward pressure on the dollar, and that means upward pressure on foreign currencies. But that's not all. When the dollar goes down, it's also in terms of commodity prices, which would go up whenever the dollar goes down. Also, equity prices, stock prices, they will also go up, and bond prices as well. So from our perspective, where we are right now, we believe that we are going to see a strong tailwind for stock prices, commodity prices, cryptocurrency prices, and foreign currency prices as the Fed begins to lower the overall interest rate, which is going to impact the value of the dollar. I think that bodes well for investors. Now, you can't rule out the possibility of a black swan event. Anything could happen, right? There can always be something that happens that jars the economy and that comes out of the blue. So we can't always know what's going to happen, of course, but just all things being equal, as they say in the dismal science of economics, ceteris paribus, all things being equal, we should expect to see the dollar coming down over time, especially this year, and that's just going to put a tailwind behind many of these asset classes. And so that's good news for investors. All right, so I wanted to get that in segment one. I wanted to talk a little bit about the stock market rising here. We see commodities rising in the wake of that CPI report for the month of April. We have been telling our members to watch that report closely, that it could be very market moving, and sure enough, it has been market moving. So good news for those who were well positioned for this report. Now, on the other side of this break, I want to talk about two important things before we close out today's podcast episode. I want to talk about the new tariffs that the Biden administration has slapped upon Chinese goods, in particular the substantial hike that they have of tariffs they've placed upon electric vehicles. That's a pretty important story. I want to talk about that briefly. And then I also want to talk about the possibility of an Apple and OpenAI integration. We've heard reports now that Apple is reportedly close to sealing a deal with OpenAI to bring ChatGPT to the iPhone. And I want to talk a little bit about that. As a long-term Apple investor, I want to just talk about some of my thoughts on that topic. We'll talk about those things on the other side of this break. Hold tight.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
Well, the Biden administration on Tuesday announced an increase in tariffs on a range of Chinese goods, including a substantial hike on electric vehicles. What we have been hearing now for a while is that the Biden administration was planning on reviewing the Trump tariffs that had been placed upon Chinese goods. And for the last year, we've been hearing that something might happen. Well, apparently the review is done, and then we heard last week that we might see some tariffs raised on China. And this week it became clear that the Biden administration is ramping up the trade war with Beijing and specifically seeking to protect the U.S. automotive industry from these low-priced Chinese electric vehicles. I don't know if you've seen some of these, Chinese electric vehicles that are being put out by BYD, which is the major competitor to Tesla in terms of electric vehicles. But U.S. automakers, quite frankly, should be terrified of BYD's low-cost, newly released Seagull. That's the make and that's the model, the make and model BYD Seagull. That's selling for around $12,000 in China. It drives well. It's put together with craftsmanship that rivals U.S.-made electric vehicles that cost 3 times as much. In fact, BYD, which Warren Buffett owns, shares in Munger as well. This has been an investment that Buffett has made into BYD. He had the opportunity to invest in Tesla or BYD, and Buffett chose BYD, which is a China electric car maker. And BYD overtook Tesla as the world's top-selling EV company last quarter in Q4 of 2023. And it's aggressively rolling out inexpensive electric vehicles and expects to overtake Tesla in Europe by 2030. And so, this has caused Tesla's CEO, Elon Musk, to warn that Chinese automakers are extremely good. They're the most competitive out there in the global market, and that they will pretty much demolish most other car companies in the world if countries do not erect immediate trade barriers. Well, obviously, Tesla will benefit from any kind of trade barriers that are imposed here in the United States. And sure enough, that's exactly what Mr. Musk got. What he ordered, he received. The Biden administration responding to BYD's aggressive approach to roll out its electric vehicles all over the world and kind of take market share as a low-cost leader. He raised the tariff, which had previously been 25% on Chinese vehicles. He raised them to approximately 100%. So he effectively quadrupled the tariff. And what this is going to do, of course, is it's going to curb the influx of cheaper Chinese EVs into the market. And it's designed to protect domestic, EV manufacturers from all this intense price competition from these Chinese imports. But it's also going to lead to higher prices for consumers. I mean, this is actually going to increase inflation, so it's actually going to cause electric vehicles, which would be falling in price, to actually remain where they are. So China is driving down the price of electric vehicles, and the United States is stepping in to basically curb the influx of these cheaper Chinese EVs. And that's, like I said, it's going to be higher prices for consumers and, ironically, slower adoption rates for EVs domestically, which is counter to what the Biden administration has been, have been seeking. Now, obviously, there's beneficiaries from a push like this. You got Tesla, right? They're the leading U.S. EV manufacturer. They're the largest in the world, all based upon the quarter that you inspect in their fight with BYD. But Tesla could see its market share increase here in the domestic market. General Motors and Ford also stand to benefit. They've been heavily investing in electric vehicles, and they don't want any competition from China. So this, in many ways, is going to allow them to perhaps capture a larger slice of the U.S. market as they roll out their new lower-cost EV models that certainly can't compete with BYD's prices. And then you also have some of the smaller U.S. EV players like Rivian and Lucid Motors. These also could benefit from the reduced competition. In addition, Biden also rolled out, in addition to the EVs and targeting that and trying to shore up the domestic, manufacturers here of electric vehicles, the Biden tariffs are also going to affect critical minerals and some solar energy goods, as well as batteries. And so investors in these sectors could see basically increase costs in the short term, but potential long-term benefits as domestic production scales up. Some of the companies that stand to benefit from Biden's tariffs here on critical minerals and battery technology and things would be companies like the biggest lithium producer here in the United States, Albemarle, a major producer of lithium that's used in batteries for electric vehicles and energy storage systems. So that company could benefit from increased demand for domestically sourced minerals. First Solar, which is a leading U.S. solar panel manufacturer, is going to continue to benefit from these tariffs on foreign solar goods. And so there's quite a few companies, I think, that are and industries that will certainly benefit from all of this. But we got to remember that the Biden administration's decision to increase tariffs here, especially on electric vehicles, is something that comes with both opportunities and challenges, because tariffs are a double-edged sword. They they can lead to increased costs and potentially retaliatory actions. And this is what we're expecting. China could certainly retaliate with tariffs of its own by raising the ante and by further aggravating the trade war that exists between the United States. That could impact supply chains. That could disrupt economic relations. And that's just something to keep an eye on. So if you haven't heard about what Biden has done there and you see electric vehicle stocks, particularly here in the United States, on the move, well, that explains, what's going on. If you look at the price of Tesla, for example, it hasn't really moved the needle too much since the announcement. And if you look at companies like Albemarle, they still haven't really picked up too much on the news. Nonetheless, I think those are some of the beneficiaries as this plays out. We'll just see what China has to say in response. That'll be interesting. Okay, so we talked about the Biden tariffs on solar goods, some solar goods, and also on EVs and critical minerals. Now, what I want to talk about before we conclude is the latest report that we've been hearing about Apple reportedly close to sealing a deal with OpenAI to bring ChatGPT to the iPhone. Now, as a long-term investor in Apple stock, I'm particularly interested in any kind of major developments like this, and I just want to talk about it briefly. I reviewed many of the reports about this potential partnership, and here's why I think it could be a pretty big deal for Apple investors. I mean, everybody knows that ChatGPT, if you haven't tried it, you got to try it. It's simply incredible. Yeah, it has some deficiencies. Yeah, it's not completely perfect. But overall, I mean, just looking at where we are compared to where we were before ChatGPT, this is a pretty big deal. Artificial intelligence is accelerating. And if you haven't seen the brand new upgrade for ChatGPT, it is simply mind-blowing, where the chat bot is now able to see and hear even more than it already was before. It's able to speak. I mean, it is really quite stunning. And so Apple understands that it needs to have an AI strategy. We're not saying that Apple doesn't, but Apple hasn't really been talking about AI too terribly much. They talk about augmented reality and things like this. Their Vision Pro headset that came out is obviously very advanced. It's incredible. You use hand motions, and it's very much mind-blowing technology. But they really haven't been using the AI word in their earnings calls, and that's kind of left Apple kind of left behind in the big rally we've seen in Google, for example, and other companies like NVIDIA, which are all riding on that AI story. So this could be a major upgrade for iPhone capabilities if ChatGPT is integrated into the iPhone. It will not just enhance Siri, but it could transform how we interact with our iPhones. And this could be the kind of upgrade that drives consumers to update to newer models, potentially boosting iPhone sales significantly. And when you think about Apple's massive user base with more than 2 billion products installed, an install base of 2 billion plus, you're talking about potentially boosting iPhone sales significantly if you have an upgrade cycle. So given Apple's massive user base, we think this could lead to a substantial uptick in revenue, which is already huge at Apple, not just from new phone sales, but also from new AI-driven features and services which they may unveil. It could also obviously lead to a boost in Apple stock price because you would really be boosting investor confidence in this stock. If the integration is successful, it could further strengthen Apple's market position and its ability to continue to innovate and integrate advanced technology like AI keeps Apple at the forefront of the tech industry. And I think it makes the stock, increasingly attractive for those looking for long-term growth in the future of AI. And I think the other key thing to keep in mind here is that Apple needs to stay at the head of the pack. They really did well in the COVID era, how they maneuvered, how they handled the situation, and how they rose to the number one largest company by market cap in the world. They've since backed off a bit from that number one spot. Microsoft moved higher. Certainly NVIDIA moved up in the ranks as well from where it was. But this particular move here could be something that helps set Apple apart from its competitors by making its devices smarter and more integrated into daily tasks. And I think this could end up locking users of Apple's products more deeply into the ecosystem. So I think Apple's potential partnership with OpenAI could really be a game changer. It'll make its devices even more essential than they already are. It's hard to believe. And it will certainly open up new revenue streams for the company. So I think it's definitely something for investors to watch closely as it unfolds. As I mentioned, I'm a long-term investor in Apple, in full disclosure. I like to follow the company and see what it's doing. I think this has the potential to really shake up the tech landscape and create some exciting new opportunities for Apple's growth. So interesting stuff there from Apple and ChatGPT potential integration. Also, Biden targeting Chinese electric vehicles. Just a pretty wild time here in 2024. There's a lot of more things going on. If you want to stay up with many of these things we're talking about, or you also just want to have an edge in the market through our ongoing education and services, check out followthemoney.com. We have a gold, silver, and platinum plan. You can check us out, become a premium member here, get access to all the things that we're talking about on a daily basis. We send out daily emails, daily trading ideas. Whether you're a position trader, a swing trader, a long-term investor, we've got you covered. Go to followthemoney.com to learn more. All right, friends, and that brings us to the end of our broadcast today. Thanks so much for joining me as we talked about many things, including the stock market at brand new all-time highs in the wake of that April CPI report. We also talked about the latest tariffs that have been placed upon China's electric vehicles and what that could mean for domestic manufacturers. And also we talked about Apple and OpenAI integration. We'll see what happens with all of that. There's lots of things on the horizon and lots of things to be watching. As always, I'd like to leave you with a final word, this time by the 1921 Nobel laureate in physics, Albert Einstein, when he said, "Compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it." And that's just something to think about, especially in an age of elevated interest rates. Thanks again for joining me here on the Follow the Money podcast. And as always, if you have questions or comments, feel free to reach out to us at our website, followthemoney.com. Be sure to share this episode with a friend. Tell others about our podcast. We'd love to see more people benefit from our resources. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Information contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial